Gold prices fell hard this week, really hard. The kind of move that makes headlines and shakes portfolios. If you're watching and thinking you might have made a mistake holding it, you're not alone. Most people feel that way right now. But here's the thing. What happened isn't a death sentence for gold. It's actually a signal that savvy investors have been waiting for. Bond yields jumped this week. When bonds pay more, investors shift money out of non-yielding assets like gold. That's basic math. So gold fell. Mechanically, predictably. Exactly like it always does when this particular relationship changes. The headlines made it sound like the gold market is broken or failing. That's misleading. What actually happened is a rotation. Money moving between asset classes. Not the end of gold's story, just a chapter change. Most retail investors see the price drop and panic. That's human. That's normal. But institutional investors? They're not panicking. They're doing something different entirely. They're watching, waiting, and some are actually buying. This is where it gets interesting, because the reaction between retail and institutions is completely opposite right now. Retail sees red, institutions see opportunity. One group is emotional, one group is calm. Which group usually makes better decisions when prices move like this? That's worth thinking about. Gold crashed about 5% in a matter of days. Sounds dramatic when you say it like that. But if you zoom out on a gold chart, even 6 months back, this move is just noise. It's volatility. It's volatility that happened to line up with bond yields moving up. Correlation isn't coincidence here. It's just how markets work. The media called it a crash, a correction, a reversal. But institutions called it a reset, a shakeout, a moment to evaluate. Same event, completely different interpretations. That matters. Here's what most people don't understand about these moments. Sharp moves down in gold aren't random. They often come before the biggest moves up. Volatility is how markets shake loose weak hands. It's how professionals accumulate cheaper. Think about the last few gold rallies in history. The 1970s, the 2000s, 2008, 2020. Every single one was preceded by moves like this, moments where retail panicked and institutions stayed calm. And here's the part nobody's talking about right now. The conditions that created this week's move are still there. Bond yields spiked. That's true. But what caused bond yields to spike in the first place? Economic data, Fed signals, inflation concerns, currency movements, geopolitical noise. None of those problems disappeared just because bond yields moved up. They're still sitting underneath the surface. This is why experienced money isn't running for the exits. They see this as temporary, a reaction to a specific catalyst, not a fundamental shift in why gold matters. Gold's purpose didn't change when prices fell. Its insurance value didn't disappear. Its inflation hedging function didn't vanish. Only the price changed. The demand drivers are still there, still active, still building pressure underneath. This is where the story changes, because what happens after these shakeouts is predictable. Weak holders sell. Smart money accumulates. Volatility gets absorbed. And then the next move forms. You see this pattern over and over in gold's history. Every time it looks the same. The shock, the pain, the selling pressure. Then the setup for the next move. We're in the shock phase right now. The selling pressure phase. The moment that shakes out emotional investors. But here's the thing about shocks in gold. They're usually temporary. The duration varies. Could be days, could be weeks, but they rarely last months without some kind of reversal. Why? Because the structural reasons people hold gold don't change overnight. Inflation didn't disappear. Currency debasement didn't stop. Geopolitical risk didn't vanish. So what we're likely looking at is a reset within a larger trend, not the end of the trend itself. This is why you're seeing unusual behavior from institutional buyers right now. They're not selling into this weakness. They're actually patient. Some are adding. You don't see that unless they believe the decline is temporary and prices will reconcile higher. Now let's talk about what's really happening underneath this price move. Because the surface story is boring, the real story is what's driving the decision-making of people with billions of dollars to deploy. Central banks around the world are still accumulating gold. Still, even after this week's drop. China hasn't stopped buying. Russia hasn't stopped buying. Other nations continue adding to reserves. This institutional demand doesn't turn off because bond yields went up 1 week. It's structural. It's long-term. These aren't traders trying to time markets. These are governments protecting their currencies and reserves. And when governments are buying while prices are falling, that's a signal. A big one. It tells you that the people making the most important capital decisions think gold is undervalued. Here's something else that matters. Physical gold demand has remained resilient despite the price drop. Dealers are still selling. People are still buying bars and coins at current prices. In fact, some dealers report increased interest when prices drop. People see it as an opportunity. This is different from paper gold like ETFs. When ETF prices fall, people often panic, sell. But physical buyers think longer term. A price drop doesn't scare them. It attracts them. This split between paper and physical is becoming more obvious, and it tells us something important. The people closest to the actual metal, the ones handling and storing physical gold, are still confident. They're not losing faith in gold. They're just seeing a price that seems more reasonable than last month. Now let's talk about the bond yield move that caused all this. Bond yields jumped. That's correct. But yields don't move in a vacuum. Something caused them to move. And here's where it gets interesting. The reasons yields moved are actually reasons gold should eventually move higher too. Inflation data came in hot. Economic growth signals are mixed. The Fed's messaging has shifted slightly. All of these are reasons markets are repricing bonds. But there are also reasons central banks are still buying gold. Inflation is still a concern. Currency debasement is still happening. These problems didn't go away. So you have a situation where bond yields spike, gold gets sold off temporarily, but the underlying reasons for gold ownership remain. This is a classic setup. This is what happens before gold recovers and moves to new highs. And this is why smart money isn't selling. They see the disconnect. They see prices falling while the fundamental reasons to own gold are still there, maybe even getting stronger. Here's the part that separates investors from traders. Traders care about the short-term move. Investors care about the long-term setup. And the setup for gold looks increasingly interesting right now. Let's talk about what happens after volatility, like this shakes out the weak hands. History shows us a pattern. When gold drops sharply, volatility increases, and then something shifts. The shaking stops. The selling pressure eases. And then the next move up begins. Not immediately, but within a predictable time frame, weeks, maybe a couple months. But it happens because the selling pressure eventually runs out of sellers. Think about it logically. If price keeps falling, eventually everyone who wants to sell has sold. What's left? People who were never going to sell at any price. Core holders. And when you get to that point, the dynamic changes. There's no more forced selling. Just accumulation, just institutions quietly adding positions while retail is still spooked. This is actually happening right now. You don't see it in the headlines because it's quiet. But if you look at institutional positioning and central bank activity, it's happening. China is buying. Institutions are patient. Retail is nervous. That's the recipe for a recovery. Now here's something most people miss about the timing of these moves. Gold's biggest rallies don't start when everyone is optimistic. They start when everyone is skeptical. They start when people like you are wondering if they made a mistake. That's actually the signal that the setup is forming, not that the move is over. Because once the skepticism clears, once prices stop falling and stabilize, then the momentum starts. And it usually moves faster than anyone expected. That's how bull markets work. People miss them because they're too scared to stay involved during the scary part. But if you stay through the scary part, the rewards come. Now let's talk about what could trigger the next move up in gold. Because it's not random. The triggers are usually catalysts related to the reasons people hold gold in the first place. Economic data could deteriorate. The Fed could shift its messaging. Geopolitical tensions could spike. Currency volatility could increase. Inflation could resurface. Banking stress could emerge. Any of these could remind the market why gold matters. And when that happens, when the next catalyst hits, gold's recovery will probably feel obvious in hindsight. People will ask why they didn't see it coming. But it was right here, in the central bank buying, in the physical demand, in the resilience of institutional buyers. The setup was forming while everyone was panicking about this week's drop. So here's where we are right now. Gold fell, volatility spiked, headlines screamed. But beneath the surface, the fundamental story didn't change. Central banks are still buying, physical demand is still there, the reasons to own gold are still valid, and institutions are positioned differently than retail. That matters. Because institutions have longer time horizons. They think in years. Retail thinks in weeks. When gold drops and institutions keep buying, that's a signal. That's conviction. Now, what does this mean for what happens next? It means gold is likely in a reset phase, a reset within a longer uptrend. These resets happen. They're uncomfortable. They test people's faith in their positions, but they're actually healthy. They shake out weak holders. They create better entry points, and they set up the conditions for the next move. We're probably going to see some sideways action now, maybe some more volatility, but the direction over the next months is more likely higher than lower. Why? Because the setup is there. The conditions are there. The institutional positioning is there. All that's missing is the next catalyst, and catalysts always come, whether it's economic data, Fed policy, geopolitical events, or currency movements. Something will remind the market that gold matters. And when it does, the move will probably surprise people. It always does, because people are focused on this week. Institutions are focused on the next year. And when you're thinking about the next year, a 5% drop doesn't matter much. What matters is that gold is still a store of value, still an inflation hedge, still a currency protection. Those things didn't change. The price did. And that's the opportunity. So as we move forward from here, watch the institutional signals, watch central bank buying, watch physical premiums, watch how dealers respond to customer demand. These things will tell you more about gold's direction than the daily price chart. The daily chart is noise right now. The underlying signals are clarity, and clarity says gold is setting up for the next move. Not immediately, but within a reasonable time frame. This is why smart money isn't panicking. They see what's underneath. And they're getting ready. Quiet, patient, accumulating while others worry. That's how you make money in markets. You stay calm when everyone is scared. That you see the setup when it's still forming. And you position before everyone else realizes it. That's what's happening right now. Not in the headlines, but in the actual market. Gold just crashed. And the smart money is getting ready for what comes next.